Mike, how does Jay Powell go to Congress and say totally near full employment, but don't worry, we're not going to go really fast on raising rates?
Because he's going to say this is our forecast and we're sticking to it. Just because we're right doesn't mean we need to change the forecast. He was sort of announced as Janet Yellen 2.0, and that's what you'll get. Now, remember, the Fed has one goal in these hearings, and that is to go in, tell Congress what they're thinking, and make no waves in the bond market.
Fair. Will he do that? Can he do that?
Unless he makes a mistake, probably he will be able to accomplish that. Now, this is going to be a very, very closely scrutinized appearance because obviously it's his first one. So the possibility somebody will glom onto something he says and maybe blow it out of proportion is high, but the Fed isn't going in there to make any news.
Jay?
Yeah, and I think one point to Mike's points is that the Fed is actually becoming less important to the markets, right?
What?
Way less important.
That's a headline. Redhead.
I know I'm not supposed to say that, but you know, you bring me on here for some reasons. But so look, I think the real issue is that the way I phrased it is that we have the best global growth economy in the last decade or more, bumping heads with a 30-year bond bull market, and that's the tussle. The Fed, which has been the real player for the last 9 years since the financial crisis, is becoming less important. All central banks are becoming less important. What's more important is basically the global growth story and in the fixed income world versus this 30-year bond bull market. And so to me, this is kind of a sideshow. The real issue is supply versus demand, right? We have in the U.S. way more supply than we thought even 6 months ago with the tax cuts and the budget. That's going to be a challenge. On the other side, there's still lots of demand for long duration, safe assets around the world. And we are huge debtors. We, the U.S., we require the rest of the world to fund our debt, and it either happens in one of two ways. Either we have to make it more attractive by letting rates go higher and enticing buyers that way, or we have to cheapen our currency and do it that way. So we're going to have some price adjustment. To me, it's much more on the dollar side than on the rate side, and I think around 3%, as we've seen in the last week, people are going to buy bonds.